All right, we've got just under 2 minutes before we're going to kick it off for the week. Hopefully, we can get a few more people in here. But if you are in the chat, let me hear from you. We got JWP806 checking in. Good to see you on the Twitch chat. Hopefully, you just like us had a pretty good week in the market, and hopefully, we can figure some stuff out tonight to have an even better one next week. There we go. We got Dashio and Jiggy Snipe. Appreciate you guys being on here every week with us. Just over a minute left. Side note, it is currently, I think, 86 degrees in my bedroom right now because the AC in my house is broken. So I've got the window right next to me open. So if there's any weird background noise, I can assure you those are just the sounds of the city joining us tonight. And for a minute there, my internet wasn't quite working too well either. So I was worried nothing was working when I went to go get everything set up for tonight. Just under 30 seconds to go. All right, that is the time, and we are going to get this thing started. So appreciate those of you who are on right at the beginning of it, but we're going to do it the way that we always do with a quick recap of what we did last week. Going to try not to spend too much time on this and spend a lot more time on the analysis because I think we were able to find some pretty good stuff last week, and hopefully we can set something similar up as we head into the trading week. But a quick rundown of last week. UWMC shot up, so we rolled our calls up to 9 strike. That's looking like a really good decision. I think we're going to make about $400 or $500 more from doing that. ICLN, super boring play. We're going to let sit. PSTH, the 22.5 covered calls we sold. That set of shares got called away for $975 in profit. And overall, PSTH got us about $2,500. That was a really solid play for us. And we still have half of that position. We've got 1,500 shares that we're waiting until tomorrow morning to sell covered calls on. BBIG was another one. I guess we could lump BB into that conversation as well. You know, a couple of these potential high-flying stocks that we've seen so much with all of the hype around the stock market on social media. These were a couple that we decided to, get a little bit of a position in to see if we can make something happen. BBIG, it ran it ran almost up to $6 at one point. The premium on the 7.5 was out of control, but we got out of this a week early because these were going to expire this Friday. But we were able to take a nice gain on the stock and a minimal loss on the call. So all in all, a $670 profit there. So we were happy with that one. BB dropped a bit. We initially had 30 strike covered calls. We knocked the premium out on those down to 20. And we were at a point where it was dropping on Friday, but the premium that we'd collected exceeded the amount of loss on the stock. So all in all, we got a $72 gain, which isn't much. But hey, if every single trade we open up ends in a gain, we are going to be looking pretty good. And that brings us to BIIB. That was one that we came up with on the a trade idea that we came up with on the stream last week for those 215 strike puts, and those paid off big time as they got approved for their Alzheimer's medication. And even after that, I think they ran up to 450 or something and started to fall back to 400 just because the implied volatility that event brought. We were able to still sell some 300 strike puts for 70 cents a pop and close those later in the day for 30 cents a pop for a quick 160 profit. So all in all, really nice $1,100 profit on BIIB. Ride was a similar situation. A really sharp drop created some serious premium in the puts, so we were able to scalp a little bit of that. We've got JWP in the Twitch chat asking if we've seen all the drama following the BIIB Alzheimer's FDA approval. And I've seen a little bit of it. As far as what I've seen, it might be a little bit questionable as to why the medication was approved. From what I had read, it seemed to be effective at treating something, but not directly the disease. So a lot of people in the medical community were a little bit maybe uneasy about the approval. Yeah, we've got in the chat 4 FDA people resigned over it so far, which is wildly controversial, but we objectively would hope they would make good progress on a cure for Alzheimer's. But as far as the play that we set up, it worked out okay with the approval. Whether or not that approval was warranted, that is I will leave that one up to the experts. We are simply here for the trades. But LOTZ was another one that we set up a couple weeks back, and from the when it bottomed out at $4 a share, that one's sitting at 6.15 as we head into the next week, so we're looking good there. Zillow is one that we've been going to the well time and time again. Something that I do want to point out about this one is Zillow finished above 107 on Friday, so we would have hit max profit, but we got into a situation, I think on either Thursday or Friday morning. Last week was a little bit of a blur, so I don't remember the exact day, but where the price was pushing 107, which means with a day or 2 days left to expiry, we're sitting right on that strike. We had the opportunity to get out and lock in a 50% gain. Now, if we had waited it out, we would have made another 14. We would have made another $800 or so. So we do regret that a little bit in the sense that we could have hit max profit, but at the same time, the core idea behind our strategy is that if we keep making small gains off every individual trade that we make and stack those up, we are going to look great in the long run. So that's what we did. We closed these out and we rolled them, as you can see, the next week to 100 strike puts. So those are already looking pretty good. They're down to 27 cents a premium, so we're already looking at a really nice gain on those, and it'll be like, our maybe opportunity cost of closing these early is already going to be resolved in the following week. So we're looking nice there. RH was one huge mistake that we made. We opened a 526.80 strangle, and we could pull that quickly because I think it's equally important sometimes to talk about the losers as much as the winners. And hopefully this chart can load for it. Awesome. So here is what we did, and no regrets. I regret the fact that this trade, but there's no regrets with playing the numbers game like we play, because you're always going to have losers. But the idea behind what we're doing is mathematically there are going to be way more winners than losers, and you're going to make money in the long run. What we had set up was finishing the day right before earnings, and earnings is denoted by these two little icons down here. But it finished the day right before earnings at about $613. So we looked at TD Ameritrade will tell you up trade tab what the expected move for the week is. So using that information, we plotted the upwards expected move at this line and the downwards expected move at this line, and we zoomed out on the chart a little bit to I think about 180 days and said, okay, the upwards expected move lines up nicely with this point of what seems to be resistance, but let's move it up to the next point of resistance, which is right around 680 leg, and we did something similar on the put side. Instead of selling 580, we bumped it down to the next area of resistance at 540. So that's what we did. We sold a 540 680 strangle, meaning if RH Restoration Hardware finished between these two red lines at the end of the week, we were going to hit max profit. What happened, unfortunately, was that a high of 710 720 right after earnings. And since this is what's called a naked strangle, meaning we really had unlimited upside loss, we had to cut our losses. And unfortunately, we lost 2,100 on the initial position. We were able to sell a couple 720 calls that finished for max profit. So all in all, we lost 1,140 on the overall position. But the frustrating part is if you look at where it finished at the end of the week, we sold, the call leg was at 680 and the premium we got was $5, meaning our break-even price was 685. So if we just didn't touch it and waited like Thursday and Friday and sat on our hands and didn't do anything, the play would have turned out profitable. And, that's kind of what you expect when you set up plays like this, looking at, mathematical ways to get to, and when I say mathematical, I mean looking at things like the expected move during a week, but using those methods to get to the strikes on the strangle. So, it would have worked, but at the same time, protecting capital is the number one rule. And, I should say one of the number one rules, because there are so many times I feel like I say something is the number one rule. But, we have to protect capital because, over time, look, it only ended up being a $1,000 loss. As you could see with what we did the rest of the week, we could make up for a $1,000 loss pretty easily. So it's important to make sure that when we have a naked position like this, we're most concerned with keeping this at, a $1,000 or $2,000 loss, as opposed to letting this get out of hand where it runs to 750 or something. All of a sudden, you're looking at a $6,500 loss. That's a little bit more difficult to come back from. So, you know, it's okay we took a small loss in the short term. If you look at our strategy page, these naked strangles are still, even though that was a one big loser, they're still up overall. And I do need to actually update this because this is actually part of the play, that 960 of profit. So if we add, oh, we already did add that 960 of profit. Whoops. Anyways, even taking that into account, that 1140 loss, the other naked strangles we've run are overall profit. Every strategy we've run is overall profitable, so not terribly worried. It's just one of those things that sucks to have happen on the back end of a pretty good week. So, but something I also felt was important to talk about because of, one, the way that we chose our strikes, two, you know, how we manage a play that moves against us, because realistically, I'd love to come on here every week and say, oh, you know, we did this play, it worked. We did this play, it worked. We did this play, it worked. That's not going to happen every single time. You're going to have plays go against you, and, you know, highlighting how we manage that and cutting our losses, I thought was something that was important to bring up on the stream, because, you know, limiting a loss and, you know, losing $2,000 instead of $4,000 is almost as good as making $2,000, right? Limiting that loss is the same as making it back. So, you know, cutting the losses when we saw it moved against us and getting out of that trade was something important that I'll look to do in the future, and something that I wanted to highlight. UPST was a super interesting one, because this play actually, we couldn't lose money on it. And I'll show you what I mean right now by going over to good old optionsprofitcalculator.com. And to answer Will House in the Twitch chat, I am sweating right now. I took a cold shower before the stream because I wanted to, you know, I figured that would help. I played golf today. I was still a little bit sweaty after that, but after the cold shower, I can report in an 88-degree house, I'm finally back sweating again. So hopefully the sun's down now. I'm hoping it cools off. But going back to what we did, it was a 3-leg play. Here's what we did. As you can see, the first play right here was UPST 618 45 strike call. We sold 2 of those, and I could put UPST on there. We wrote a 45 strike call expiring June 18th, and we wrote those. We're gonna have to input the price because they're not updated. 116.90, and we sold 2 of those. What we also did was we wrote 2 280 strike puts. Right there, 280 strike put. And we did that for 136.10. And again, we sold 2 of those. And one thing I do want to point out is this play by itself is a strangle, right? Because we're trying to keep it between 45 and 280. And that noise in the background was my window slamming shut by itself. That scared the hell out of me. But we're going to keep moving to show you what would have happened, right, if we only did... Oh, it's going to make me put in all 3 legs. Whatever, I'll put in the 3rd leg just to show you guys what the trade looked like. We purchased 4 240 calls. So if we go over to that, 240, and we bought those for what looks like 257 on average. 257, we bought 4 of these. And now let me show you between 0 and, I don't know, 400 what this play would have looked like for us. And as you can see, there's really 0 risk on this play. And if you wanted to get crazy, you could add a 5th leg where you just purchase a 40 strike put, and all the downside risk here would have gone away. But what's happening, right, is if we sell a 45 strike call, you know, that's effectively a quote unquote a short position. We want the stock to go down. So we would make money if it goes down. If we sell a 280 put, that's a long position, meaning we want to make money if it goes up. So these kind of balance each other out. And then the other issue with that is that if we sold a 280 put, potentially the stock could run way up and our loss would be unlimited. So in order to avoid an unlimited loss, we purchased 4 long calls that made it so that if it ran up, instead of, you know, facing an unlimited loss, we would actually make more money on that upside situation. And similarly to this downside risk you see right here, if we purchased a 40 strike put, this downside would be completely eliminated. So if you actually go over here, I put this one in before. This has that 45 strike put, and if you calculate what it looks like, they don't even know what color to shade it, because every single outcome here is a positive, meaning you would make a minimum of $2,700 on this position. And if it ran up to, like, you know, $500, you'd make 61 grand. There's significant upside reward on that. But moral of the story is we were able to identify a situation where it was legitimately a risk-free play. Now, I do say that, you can't really see me because I'm not on camera, but it's, quote, risk-free. There was one issue with this play that could have made it, that could have given us risk. And that is, all three of these things, right? We've got a 45 strike call. If someone exercises that, they're just going to be short. We're going to be short shares. A 240 strike call, we own those. We don't need to worry about those being exercised because that duty falls on us since we own those. And a 280 strike put, these had a lot of extrinsic value on them. So if someone exercised those, they would be forfeiting that extrinsic value and we'd be making money off that. So the only issue here was with assignment on the 45 strike calls. And they were so far in the money and had no extrinsic value. So when you see something like that happen, you're normally likely to get exercised. And let me pull up UPST here to kind of show you what we're looking at. You see this column right here that says extrinsic, and this shows you the extrinsic value in the puts. And this opportunity, might still kind of be there a little bit, because what you see when you go really deep into the money, and let me pull up another stock here quickly to maybe emphasize this point. Looking at Apple here, when you go deep into the money on the put side, you're going to see that extrinsic value. We might have to go out a couple months or a couple weeks rather. You'll see extrinsic value at this level, 130 is about 76 cents. So at a 130 put with 76 cents, that means on average you would expect to see a call with 76 cents of premium. When you go to the call side, that's exactly what you see. 76 to 78 cents of premium. There's no put or call skew on Apple, and that's the case with most stocks on the market. But when you go to UPST, you go to 200 and you'll see, okay, there's $5.20 of extrinsic value on the deep in the money put side. That means we would expect, if we looked at a 200 call, to see $5.20 of extrinsic value, and we don't here. In fact, we see just under half of that, right? Maybe halfway between 135 and 275. So about, $2 of premium. So you have a huge difference here between $5.20 in extrinsic value on the in the money put and the $2 of premium on the call side. And this is known as put skew, meaning that the puts offer far more premium than the calls. So what can we do when we see a situation like that is set up a play that looks like this to take advantage of that. And, I could go into this another time, and I think it would be a super interesting thing to make a video about as opposed to, try to explain live on a stream, because it's a little bit complicated because, if you're in the money on a put, we always know that at expiry, the extrinsic value is going to be gone. So no matter what, this $5.50 of extrinsic value is going to disappear on June 18th, which is when these, here we go. This is a better example. So we've got 615 on the weekly puts. This is actually June 18th. We were still looking at the wrong week there. And there's like 160. So there's even a bigger disparity on the June 18th between the extrinsic value on the deep in the money puts and the premium that the calls are offering. And that is where our opportunity on this play lies, because we'll always be able to collect this extrinsic value, because that's how option selling works. We make our money from extrinsic value, meaning we're going to make, for every one of these we sell, $6.50 of premium no matter what, because we're going to collect that extrinsic value, and we hedge that by paying $150. So the difference between the $6.15 that we collect and the $150 that we pay to hedge it, is roughly $4.50 of free premium that we get to collect, and that is where the risk-free trade comes into effect. But, that's only two legs, right? That's us looking at selling a 200 strike put and buying a 200 strike call. We know that buying a call is bullish. We know that selling a put is bullish. So if the stock drops a ton, we're in trouble right here, despite the difference in the premium. So that is where we sell the 45 strike call, because this is effectively, with no extrinsic value, the same exact thing as a short position in the stock. So every dollar the stock drops is a dollar that this is going to drop, meaning a dollar of premium we collect. So that is going to offset any losses from the 200 strike put, right? So we have the 200 put we sell, the 200 call that we buy to hedge the put, and then the 45 strike call that we sell to hedge the put as well. So that probably sounded like a lot, and I do think it would be a really interesting thing to make a video on. But long story short, that was probably the single most excited I was for a trade that we made last week, putting ourselves in a position where we literally couldn't lose any money, except with that asterisk of a broker imposed risk of having your 45 strike call exercised and then the broker closing your short position. So, and that's something you can mitigate by being in constant communication with your broker and letting them know what you're planning on doing with a position like this. But, I at least wanted to highlight that a little bit. I know I said we would quickly run through the recap, but I thought this was a super interesting play. We got out of it early just because I got tired of the broker, of that 45 strike call being assigned, having to buy the shares back and sell another 45 strike call. That got a little bit tiring, so I closed it out, nice $1,800 profit, and we're moving on to next week where we really don't have, that much in play. And this is always a great position to be in. I am always guilty of wanting to open as much plays as my buying power lets me. But with where we are in the market right now, I do feel, and something that is, common for me to say, I feel like we're pulling back at some point soon. And while you're never going to be able to pinpoint a super big drop in the market or a crash in the market, I think we can reasonably expect that one is coming at some point soon. We have been moving pretty much upwards for the last few weeks. I mean, we dipped midway through May, but recovered back to all-time highs without much of an issue at all. And it looks like we're starting to level off a little bit here. I mean, I'll let the TA people who could draw the bottom support intersecting with the upper support here make what they want to make of that. But in general, I mean, even just backing up to we are at the 180 day, just the 1 year chart, right? You don't typically go this far without a decent drop or pullback in the market. And if you back it up further to like the 3 year chart, I mean, we've been running away since COVID. Even before COVID, back in 2018, we had a drop from 300 back to 230. We had pullbacks from 301 to 282. And that in the scheme of things isn't even that big of a pullback. We saw one from 295 down to 274. So that's 20 basis points on S&P 500, meaning that would put us back in this range. And if you compare those at a percentage wise, and it would throw us right back in this 385, 390 range. And that's right where we might see a little bit of support. And I think that's a reasonable place to expect a pullback if we do see a dip in the market. Now, I could be completely wrong because, I mean, for the last, since last March, almost for the past calendar year, we've just been ripping straight up in a line, and, there's no reason that needs to stop. Logic would tell you we're probably due for something like that. Concepts like reversion to the mean would indicate that we could be pulling back pretty soon. But, just in case we don't, I've still got a little bit of money on the table in play. We've got that UWMC position, which should close out nicely above 9. We've got that Zillow position, which is, probably as long in the market as we're looking to be right now. The other issue is that we like to sell options for lots of premium, and premium is driven by volatility. If we look at VIX, volatility is as low as it has been since right before the COVID crash. And that is saying a lot because VIX is, quote unquote, the fear index in the S&P 500. Typically, when you see a bunch of red candles in a row like this, it'll spike back up at some point. I'm not trying to guess what day of the week, what week of the year, what month of the year it's going to happen, but I do think it's important to be prepared for when it does spike back up. And right now, volatility isn't high, meaning premiums aren't very high, so we're not going to get the greatest returns. So what that means is, in the short term at least, I know I've sworn off these premium chasing plays, but it isn't the worst idea in the world to maybe target a few positions like this where premium is inflated on stocks independent of, themes in the overall market and overall premium that we're seeing and volatility in the overall market. ATOS and AHT are stocks that have kind of been flying all over the place, but a 4-strike put on ATOS and a 5-strike put on AHT give me what I believe to be decent entry points on those respective stocks. And, 35 cents a premium on a $4 stock is an enormous amount of money from an ROR perspective. So I'm perfectly happy to, even though it's a little bit riskier, put myself in a play like that just to have some money on the table and get something going when I'm kind of sitting on my hands for the overall market. Zillow is one that I'm happy to be in at 100. We've talked about that before. The 3-year chart's going to be a little bit misleading to my analysis here, but really good support here at 105 and further support at 100. So our game plan here has been selling every time it dips, and we're currently in on the 100s expiring this Friday, and I'll just keep rolling those things, planning on playing it up until it runs back above 120. But any price 120 and below, I'm perfectly happy owning this stock at. So this is going to kind of be one of those bread and butter plays that you'll see us holding on to for the upcoming weeks and months. And, no reason not to, because it's been going super, super well for us. If we look at our trade performance, I think you've got Zillow on here. That was a gain, another gain from Zillow. We've got another bigger gain from Zillow, another gain from Zillow, and another gain from Zillow. We've opened Zillow 5 different times so far, and we have come out with what looks like, about $4,000 in profit. So we're going to keep riding that one. Another stock that gives us really nice margin privileges, margin buying power requirements, I should say. And what do I mean when I say that? Let's go pop over to these 100 strike puts to give you an exact example of what I mean by this. So we know typically if we want to sell a put, it's going to be cash secured, meaning there's enough cash on hand and locked up by the play to purchase 100 shares of the stock. So if you wanted to sell a fully cash secured put at a 100 strike for Zillow, you would need 100 times 100, which is $10,000 to fully cash secure a put. But, that's a lot of buying power for, what might be $100 of return. With margin buying power privileges, this only locks up $1,133 instead of locking up the full, $10,000. So certain stocks are valued in certain different ways. This is one that gives you 10-to-1 leverage because TD Ameritrade judges it as a relatively safe play. So instead of, we've done the math on something like this before where, let me pull the calculator up really quickly. Hold on, it's coming. Here it is. Instead of, making 25, and, this is a bad example. Let's look to the next week because premium for this week might be a little spent. But yeah, if you wanted to sell something for a halfway point of about 50 cents of premium. Give me 1 second. A bug just flew into my window. All right, we are back in action, I think. I think it flew back out. Okay, we are back. Anyways, we've got the calculator back up. If you wanted to sell one of these for 52 cents, we know that would be $52 in premium. And I think I panicked, closed out the calculator. But, that'd be $52 divided by 99.48, which is 0.5% return, nothing to be writing home about. But with the margin privileges we get, it's now a $52 return divided by 11.33 in collateral, which is a 4.5% weekly return, which is phenomenal on a week-to-week basis. Now, when you're playing with leverage like this, you've got to be careful because if the market tanks and this goes down, you could lose more than you've got put in. That is why, one, we're comfortable using leverage on a play like this because, we're not really using leverage anywhere else right now. And two, the amount of money that we have in play is less than half of our available buying power. Going back to that conversation we had about keeping as much premium free as we can, keeping as much, lost train of thought there. Going back to the conversation we had about the S&P 500 potentially pulling back, we want to keep as much cash on the sidelines as possible so that when we do start to see dips in the market, we could take advantage of it by deploying that capital. And if S&P 500 doesn't dip and we're able to keep collecting premium week after week after week on stuff like this, we'll happily take our leveraged 4.5% return per week on this stock. And we are perfectly happy with doing that until the end of time because a 4.5% weekly return is a huge, huge, huge number. So that is the idea behind those Zillow puts. We've got these on here because, like we mentioned, we are in a low volatility environment currently in the overall market. So there aren't a lot of great premium chasing plays. Earnings are another vehicle that we like to put our money in to identify, other areas where premium might be great, where in the overall market it's pretty low. We try to do that with the Restoration Hardware. I know some people on our Discord did it with Chewy pretty successfully on Friday. But one of the things we are going to continue going back to those earning plays time after time again. Don't let one losing play, if you follow us on this one, get you down, because overall, as we've seen from our strategy summary, our pure earnings plays have made money. Even the Naked Strangles overall are positive, and the Iron Condor is we've only done one of those on earnings, but overall, and this is a pre-earnings play, so we're going to exclude this. But I mean, overall, we're still pulling pretty good money on these earnings plays, and especially when you're worried about a drop in the overall market, doing something like an earnings play where the movement of the stock is much more directly tied to earnings results as opposed to being directly tied to the overall market is a good way to detach yourself from that downside market risk. So if the market drops, has a terrible day, drops 1 or 2%, but the company you're playing beat earnings or something like that, you're probably not going to see a huge crash in that individual stock. The ecosystem of stocks you're playing are going to be a little bit removed from the ecosystem of stocks that are more affected by overall trends in the market. So that is something I really want to emphasize, and why we're probably going to be a little bit heavier on those until we start to see a little bit of a dip in the market where we could scale back into our HT wheel, our typical strategy that we've seen, from the beginning of the year, rather, in the beginning of when we started tracking forward. But one thing that I've always been critical of myself about is the fact that I haven't done the greatest job holding on to cash for when the market does turn down. I can't say there's a single time when the market has dropped where I wish I had less cash on hand. So that is something I've identified as being an area where I can improve, and something that, as you can see by the lower amount of plays, and these are quick plays we scaled into during the week, but we've been holding a much lighter portfolio on a week-to-week basis and patiently waiting for the pullback to come. So while we may not make as much as we possibly could, I mean, don't get me wrong, we're doing really, really well. We made almost 7% last week, and if we go to our year-to-date summary page, we're still coming out on top despite maybe getting some FOMO about being conservative. And if this is what conservative looks like, I'm perfectly happy with that. So that will get us finally into our overall discussion of, what comes next. What are we going to throw on our watch list for this upcoming week? And I'm going into this completely blind. I have no idea what I want to throw on the watch list. So if you guys are watching along, feel free to throw any suggestions into the chat. But we are going to do what we always do here and start off with a little scan to see what's popping up. And this is let's see, this is me trying to find more of those UPST type scans. So let me load in the high premium puts scan. No earnings in the next 10 days. And this is just the S&P 500. We're going to start with a little bit of a smaller scope and then expand to a larger scope. And I don't know if this is, let's see here. Take a look at MU. We'll definitely get that one for you. KB in the YouTube chat. I'll run this scan again really quickly with a little more, some more results. And maybe 2.65 is the biggest. That's surprising to see. Normally we see some much higher numbers. We got Prinsmeister in the Twitch chat asking about Sage, having some pretty high ROR. So we'll definitely look at MU and Sage in just a minute here. But let's go down the list of what we've got in the S&P 500 that's providing good ROR. The first one that we can see on the list is APA. I really have no idea what APA is. All right, so APA is an energy company. They operate through subsidiaries, blah, blah, blah. Oil and gas company. So, if we look at the overall trend here, what we do like to do so often is start a little bit further out, looking at the 180-day, and maybe zoom in and focus on what we like for short-term trends. But as far as what we're doing in the context of our strategy, something being this high above where it was 180 days ago is a little bit scary. We could take a look at the premiums just to kind of follow this train of thought and close out the loop on it. Let's go to return on risk here. And I'm also going to put volume to make sure what we're looking at has decent volume and being something we could trade. Nothing looks crazy good. If we look at maybe the last month of trading, we could see that there's a huge candle on the 1st of June that took it up to this low 20s range. Maybe somewhere in this 20, just above 20 is a point of support. If we wanted to sell 21 strike puts, even that doesn't put us too far into a point of support. Maybe there's a little bit of margin we could have here, right? Maybe it looks like only 33%, and we deduce that by seeing our max loss is 2,000, which is what it would need Well, that's the buying power that would be required if we wanted this fully cash secured. It's only going to require 743, so about a third of that, meaning that the margin requirement is about 33%, but still nothing to write home about, really. I don't think a $13 profit on $743, especially when you're still above that support range we looked at, is anything noteworthy. We could look at INCY really quickly. Insight Corporation. It is a biopharm company. So healthcare, biopharm, that is an area we like to stay away from in the context of our strategy, because one piece of news could come out and that would absolutely ruin us. And we hate to maybe put ourselves in positions where if the stock, we hate to put ourselves in positions where the stock could drop so sharply that we aren't able to sell a sufficient premium to lower that break-even price and help us get out of the trade with a profit. Healthcare, biotech, biopharma is an industry where that happens frequently, so we try to stay away from those. BIIB, that's our good old Biogen. We could take a peek at that. Looks like puts here still offering a little bit of premium, and it's 0.64% ROR at 365. This would scare me a little bit because there's a pretty big gap between 378 and 300. If they break that downside support, there's no telling where that thing could end up. But, I mean, we could see what one of these, especially with the lowered margin requirements on this, you'd be pulling. Well, normally it would take $36,000 of buying power. It only takes 5,200 now, so it looks like about 20%. That's not right. It's between 5 and 10%. We could pull the calculator back up really quickly to see what that would be. That'd be $245 divided by 5,269 of collateral for a 4.6% return. Not too bad, but that's a little bit too much leverage for me for a stock like this. We got a question from JWP saying, do we ever recommend selling credit spreads to decrease buying power requirements? I would say yes. I actually built my account up with exclusively credit spreads, and I kind of owe a lot of where I am today with those. Now, admittedly, I was a little bit aggressive and had a little bit of a hot streak, getting lucky selling a bunch of winners in a row to build myself up to where I was making an amount that I was personally happy with on a weekly basis from, the overall HT wheel strategy. But it's really all about your personal risk tolerance and what you feel is a good return on a week-to-week basis. Now, I'll be the first to tell you, I think, patience and aiming for 1, 2, or 3% a week. Understanding you're not always going to get it, but, aiming for that in a best-case scenario on most of your trades is a much more sustainable way, combined with if you're working a job or something and just being diligent with saving money week after week and month after month and building your account up that way, as opposed to getting crazy with credit spreads. But the reason I like leverage, and I guess this kind of ties these two ideas together, I like leverage as a way to be more capital efficient because, it lets me play maybe not BIIB, but stocks that are higher up like Zillow, for example, where I'm really confident where it is from a price perspective, but I don't want to sink a bunch of capital into it on a week-to-week basis. That's where leverage helps. If you wanted to sell a credit spread, that could also be a similar type deal. If you wanted to sell a vertical spread, maybe 105, 106, decent ROC right there, but you run the risk of hitting this max loss if it drops below 105. And what I like better about selling cash secured puts on leverage is that if the stock goes down, you're able to, you have some recourse. You're able to recover from that, as opposed to where in a credit spread, there's a little bit of rolling in defense that you could play with those. But more or less, it's kind of all or nothing, unfortunately. All right, and we have got some good discussion in the chat really quickly, so we could circle back to that and look at a few of those names. We've got KB in the YouTube chat asking about MU. Let's throw that one up there. That's going to be Micron, the chip maker. And wow, a huge red candle back on June 8th. And the way these chip manufacturers trade, I'm sure that's some sort of correlation of what's going on in the industry, because it doesn't look like much was going on. And a good way to figure out, what caused this on the 8th is going back to the news wire on the 8th. Let's see what happened on the 8th. Micron shares are trading lower. The move is possibly due to a Digitimes report suggesting DRAM prices will continue to rise in Q3, but at a slower rate. So, I guess some potentially bad news for Micron. Let's zoom back out. And it's been in this range for a while, I think. Yes. And, not too bad. What scares me a bit is it's nearing this maybe longer term level of support right here that you could see at 76. A little bit more support here at 74, but down to 79 off the highs of 96. Not a bad entry right here on this stock, and we love to look at RSI so often, and the 180-day RSI indicates that 37, it's a little bit more oversold than overbought. So in the short term, potentially you could expect to see a little bit of a correction, but let's take a look at what the weekly option chain is looking like. So we mentioned that, let's see if we zoom in a little bit here. It bounced in the short term off 78. It looks like 77 down to 73 might be a little bit better of a range of support. So let's see on a week-to-week basis, can we sell something at 77? We absolutely can. And, conversely, instead of just looking straight at 77 because we know that's support, we could also look to enter a trade that puts our break even at 77, which would, roughly be these 78 strike puts, which put your break even at 77.25, which is close enough to that 77 point of support. So let's take a look at those. Those are providing a 0.95% return on risk, which we know 1% a week over the course of a year, I think compounds to about 30%. So that's something important to keep in mind, especially when the overall market on average only returns 9 to 10% a year. And that, is one of the single most important things I think you should keep in mind when you're trading and searching and looking for different trades and trying to figure out what kind of a return you want on a week-to-week basis. 1% is really good. If you pull 1% a week, you're going to outperform almost every hedge fund on the planet. Even though that seems like a small number, I promise you it is a really, really good return. So don't be discouraged by seeing a small number there. But what could get me even more excited about this one is if we finally look at the leverage, see what buying power requirements are looking like here. We're going to pull the calculator back up. We see that 1% return on risk right here being a $72 profit divided by the 7,700 potential max loss. But as we can see, we get some decently reduced margin buying power privileges here. So we now have a $72 return divided by what the broker only requires, $14.53 of collateral, meaning that's a 5% return on capital as opposed to return on risk. So really not a bad option, and this is something I could see myself throwing onto my watch list to potentially enter into on Monday morning. We're going to throw that on there. MU 61870, I think we call those 78 strike puts because those are going to give you just about 5% ROC. And just to further, we talk so much about we talk so much about these annualized returns, right? That I haven't actually updated this website in a long time, so apologies for that. So I've been super busy with work, but hopefully I can get back into the habit of updating these a little bit more. But if we have a play that lasts, we'll call it one full week, even though it would only be 5 days. We'll call it a full week for annualization purposes. Even a 0.98% return. There you go. Excuse me, I was way wrong. A 1% return annualizes to 66% over the course of a year. A 2% return gets you to 180, and the numbers get crazier and crazier as you walk up. 1, 2, 3, 4, 5. But we know what we were looking at was a 0.98% return. That's going to get you a 66% return annualized. And one other thing that I added onto this annualization calculator is just a quick example of if you put $10,000 into the market and you pulled 1% per year, within 5 years, that would be up to 6 figures just off trades that seek out, 0.98% returns a week. And that's not even close to factoring in potentially that return on capital using the leverage that we've talked about. So every time you see a trade that we're looking at here and you say, oh, it's only a 0.95% return on risk, don't be dissuaded by that, especially if it's on a week-to-week basis. So if you get a 1 week trade that pulls you 1%, that's a 66% return annualized. You will be crushing almost every professional investor on earth with that. So if you think that's something you could accomplish every week, absolutely go for it. But what I really get excited about is what we calculated a second ago with this 4.95% annualized return that the leverage gives us, which is over 1,000% annualized. And, these numbers are almost hilariously irrelevant because, here's the deal at the end of the day. You're not going to pull 5% every single week in the market. And realistically, you're not going to pull 1% every week. We have been really, really, really good this year. We've pulled 2.31% per week, which annualizes to about 228%. But we do want to keep all of our trades in the context of, setting out realistic expectations. So many people go on Twitter, YouTube, Twitch, and say, okay, we're pulling 100% in a week. Those people, I don't doubt that they pulled 100% a week. Your first question to those people is, let me see your all-time chart, because there are people who go play the lottery who pull more than 100% a week, but it doesn't mean the lottery is a good idea. So sticking to these small weekly returns and compounding these returns week over week, month over month, and that turns into year over year, is going to put you in a really good spot. If you stay disciplined, stay seeking out smart trades like this, and stay focused on the plan at hand. Don't throw all your money into super risky plays and keep compounding these small gains. And to close the loop on that, shout out to, what's the name right there? Mauricio G in the YouTube chat. Sorry, my screen was super, super small there for a sec. Appreciate you watching. Always appreciate people checking in the chat. And happy to give anyone who checks in the chat a shout out on the stream. But that's to kind of close the loop on the point we're making there. Is you might say, 0.95% on a week-to-week basis, that sucks. The answer to that statement is that it does not suck. You are going to be looking very, very good if you can accomplish that on a week-to-week basis. So, if you are maybe new to following us, or you're coming from an option buying background where people look for much bigger returns, that is probably one of the first criticisms that what we do gets. And just quickly running someone through those annualization calculators is a really good way to, showcase the value behind what we're doing, why we target the trades we target. And, while we might say, 1% decent on a week-to-week basis, that's why we get so excited if we can get a leveraged 5% return on capital on a week-to-week basis. But, with that said, shout out to KB in the YouTube chat for recommending MU to take a look at. I really like the way this sets up. I like the entry point that we've got here, and it might make for a good 1 to 2, 3 week trade if we could just keep selling these 78 strike puts over and over again until it runs back away up into the low to mid 80s, and we can go find something else. So the next one that got thrown into the chat was Prinsmeister in the Twitch chat. Shout out. I think he's a little bit newer of a follower, but I've seen you checking into the Discord and in the chat all the time, so appreciate that. Looking at Sage, and if Jules is on the chat tonight, this is one of her favorites. I think she plays this one all the time, Sage Therapeutics. She would probably know way, way more than me on this one. But as you can see, we like to start with this 180-day chart before we move in. What really, really stands out now is the fact that it was trading at about 65 June 3rd, literally 10 days ago, and now it is up to almost 80. So from an entry-level perspective, again, we talk so much about RSI when we analyze these individual stocks. It's up in the red. Let's take a look historically at what has happened when the stock goes up into the red. The last time it happened was on January 13th, and you can see by the vertical line this is drawn right here. Right when it got up into the red, it took a deep dive from 97 back down to 78, which is, coincidentally where it wrapped up trading on Friday. The last time before that even was the end of December when it dropped down from 90 down to 83. So he's saying, okay, even the 60 strike puts look good. I mean, hey, we could always take a look at the option chain and see what it's offering. Oh my goodness, there has got to be something going on with this stock in the next 5 days that is pumping premium into these, because this is some insane premium far beyond what you would expect to see for something like this, because you could set up a 5-day trade that pulls, even if you targeted that similar 1% ROR at a 40 strike put, you have to zoom out on the y-axis to get to 40. The last time the stock traded at 40 was back in about a year ago. So it looks like he says there's nothing out there to explain it as far as what he could tell. Let's see if we could take a look at the Newswire and figure out what's coming up this week for Sage. 5 catalysts for investors to watch. You guys, let's take a look at this. Take a look at this article on the Newswire. Here we go. Partner Sage Therapeutics is expected to report initial data from the phase 3 study testing zuranolone in patients with major depressive disorder in the second quarter of 2021. An 85% probability exists that it meets the primary endpoint, and a 50% POS. I don't know what POS. That it achieves a 3-point HAMD improvement. I went to business school. I'm not a doctor. I have no idea what any of that means. But, that is the reason, for those of you who are curious, that's the reason for all of the premium, the fact that they've got phase 3. And, well, I did go to business school. I know phase 3 is the final phase of FDA approvals. So that's going to be a big one for it. Now, the question here, and something that we could, here we go, probability of success is what JWP in the Twitch chat thinks it is. And honestly, I don't know enough to say no to that, so I'm going to roll with, 50% probability of success is what we're going to call that one. But, this is almost a similar setup to what we were looking at for Biogen, right? Because when we go over to Biogen, what we were looking at last Sunday night is that, hey, we're sitting right around here saying that, obviously this Alzheimer's approval or disapproval by the FDA is going to be a huge binary event. It's going to send it shooting up or it's going to send it shooting down. But what we know about Biogen is it's not a one drug company, right? So our question was, what's the downside risk on it? And we determined looking at, various articles, different analyst price targets, that this 215 range was probably the downside risk. So the great part about what we're able to do with our option selling strategies is we were able to sell a 215 strike put, which pretty much put our max profit point at or below, hypothetically, what the downside risk on the stock would be, so that we were going to win anyway. Now, as you could see from the chart, it shot up a ton, so we didn't even have to worry about that, and that was a really nice, I think, 3-4 hour play, as the only question mark on that play was when the stock would resume trading so we could collect max profit on it. Now, I don't know much about Sage here, but if they're in a similar situation where, they have this drug coming up that is expected to meet some sort of FDA approval deadline, is that the only drug that they have in their pipeline? Is their revenue derived from several different drugs? And, it might suck if one gets, doesn't get approval, but, even if that's the case, does it drop to 50? Does it drop to 40? What's the downside of an FDA rejection on that drug? Because there's enough premium decently far out of the money here where I think we could potentially capitalize on that. You look at the call to put volume. Looks like there's a little bit more put volume than call volume. Yeah, there's 6,000 puts traded last Friday as opposed to 4,000 calls. So not really much we could deduce from there. It looks like, if you go $20 out of the money, they're trading for about $5 a premium, where if you go 20 the other way, it's just under $5 a premium. So maybe a slight call skew, if anything, but I don't think there's enough there to prove it one way or the other. So, this one is really kind of up in the air. And if you have a reliable way to maybe take a look at some sort of analyst report, Biogen is a stock that gets much more heavily covered than this one. So we were able to find that information pretty easily. Let me see if there's a quick analysis about their, sometimes if you go to the trade tab here, for bigger companies like Apple, there's going to be a company profile button up here, and it'll pull up, a really helpful breakdown of different revenue by segment, product, things of that nature. You could click into here and you could view forecasts, iPhone revenue forecasts, gross margin forecasts. And if you say, I think iPhone revenue is going to drop, you could actually adjust that and it'll show you what you think the price of the stock will be based off your estimates. So that's actually something really interesting you could play around with. If you think, I think the Apple Watch and Apple TV are going to go away or something like that, you could drop the revenue a ton and you'll see what you, from a fundamental aspect, are estimating that the stock will be. But for, Sage, we don't have that, unfortunately. So it's tough to really say without some further research that I won't, for your guys' sake, do live in front of you, but something I might follow up on quickly, because if we determine that, hey, there's maybe only 50% potential downside here, that means we could sell one of these 40 strike puts, and you're looking pretty good, and that's a roughly 10% ROC here. You're pulling 350 off 4,000 of collateral, and the number probably look a little better if you're going up closer to 50, where you can open a trade that almost has the profile of a spread. Where, however, you have to be wary that with higher leverage comes higher potential losses if this thing comes flying down below your below the strike of the put that you sell. So if you do choose to go into that one, not the worst idea, because we know what's coming up. We know the binary event that people are expecting. And the other thing to consider is that they mentioned in the news article that it's coming in Q2. So that's any time between now and the end of the month. So it could come this week, or, nothing can happen this week and we basically collect free premium. So that's another potential outcome. I don't know if there's a concrete date about when that's going to be announced, but the way that the news article was written that we pulled up here a little bit earlier seemed to suggest that in the second quarter of 2021. No definitive date. Sometimes these things get dragged a little bit. Not the worst idea in the world. As you can see, there's a little bit more premium for July as opposed to June, because by July 2021 you could be 100% sure that that decision is going to have been announced, whereas for June you really aren't sure. So that's something that's a little bit interesting if you wanted to play the numbers game there, where one, you could win from it not dropping 50%, or two, you could win from there just playing up not being an announcement in the next 5 days. So that's pretty interesting. The 50, 45, 40 provide an interesting value proposition there, but I think that's one where I could potentially throw it onto the watch list, and I'll throw it on there for now, but a little bit more research and a potential downside upon FDA rejection would be needed for me to be fully comfortable on that one. So we'll call it 618. We'll 45 strike puts, 45p, and this provided very nice. If we look at the return on capital there, we'll throw it at the midpoint. 90 off 4,500, so that'd be 900 off 4,500 of required collateral. Is a 20% ROC, 2.33% ROR, so still really solid numbers right there. And really quickly, we're going to take a look at the chart to see if we could find any longer term support in that 40 area. Yeah, and 40, it looks like maybe around here. 45 is a good spot. I do like that number we picked right there, 45. Let's go a little bit further back to see what we could see. Yeah, 45 looks decent enough, but yeah, a little bit more research. We're going to move on to the next one, but a promising play if we could, maybe quantify some sort of downside price on that one. So the next one that we had recommended in the chat was going to be IVR, also from Prinsmeister. We're going to take a look at that one, and then after that, we're going to take a look at ALUS from Yo2131 in the YouTube chat. So IVR, this one scares the hell out of me because, this is not... It's an interesting setup, and he did mention it was similar to AHT, and 100% correct in the fact that if we back it up here, this is a 3-year, but it's a hospitality REIT, so, things like hotels, other hospitality type real estate investments that's fallen off a ton since COVID. But COVID is right around here. It dropped from 26 down to 6, and bottomed out at $1.27. Now making a little bit of a rebound in the past month or so, back from 247 up to what peaked at almost $8 a share. So okay, we've got it to REI with almost 10% annual dividend. So good to know that IVR pays a dividend. That's interesting information. As far as entry point, this scares me a little bit. However, when we look at the RSI, we saw that it got up into the red. Let's back up a little bit here. It's still in general overbought. There's probably a decent bit of support in this $4 range. Let's see what we could sell on it. That's really not too bad. I don't hate the idea of 4 strike, what are really weekly puts on IVR, and then you get yourself in a position where there's so much potential upside here that people might be afraid of, that you'll be able to get a decent amount of premium on covered calls if you choose to take assignment and go that route. So 4 strike puts really aren't the worst idea in the world, in my opinion, because you'd sell a 4 strike put, you subtract what, 12, 13 cents of premium on that. That puts you at a 387, 388 break even price. So as long as it stays above this level for the next 5 days, you're going to be looking pretty good. And, while it did trade down near 330 for, the better part of the time between May and right now, looking back at this 180-day chart, you see a decent trend. It pays a dividend, so that's always something good. And yeah, like you mentioned in the Twitch chat there, Prinzmeister, even though that's a 9-cent dividend, we know that's a direct reduction of our basis should we choose to take assignment and ride along with those shares. And when you look at it as a percent of the stock, it's a really nice annualized percent return just from that dividend. So really not a terrible idea here. It looks like if we look at the 1 year, the short-term downside is really only maybe 250, 275 range. And with the amount of premium this thing's shelling out on a week-to-week basis, that's the other thing too. A lot of these smaller stocks, you'll only have to sell on a month-to-month. The fact that we've got weekly options in here that we can be collecting on is also incredibly encouraging. So, I mean, you could sell a 3.5 strike put in October. This is kind of funny. For what, 45 cents a premium, only takes 955 in buying power. So you can sell a 3.5 strike put that'll give you effectively a 50% return on collateral, return on capital, and all it has to do is stay above 350 by October. Now that's an example of, a more long-term play. I like the week-to-week action if you're able to stay on top of something like this. And, I say stay on top of something like this, but really you only need to be checking it once a week. So it's not like you need to be glued to your screen or something like this. The second you sell one of these 4-strike puts, you could just let it ride for the rest of the week and check back on it. But yeah, like I mentioned earlier, VIX is low in comparison to the overall market. So there aren't going to be a lot of great traditional premium plays for our HT Will strategy that we're going to be able to identify via scan and scale into. So, areas like this where premium is elevated might be good places to throw your money right now. So I like the idea right there as well. IVR, and we could call that 618 4P, and we can see right here this gives us a 3.23% return on risk. But when we look at return on capital, it looks like just about a 50% margin buying power privilege, I guess is how I can refer to that. So 120 divided by 1455 is an 8.2% ROC on the week, and that is that's not too bad. 8.2% ROC. That's going to go on the list. I like it. I like it. I like it. And now we're going to be looking at ALUS. That was a suggestion from the YouTube chat. Lusa Energy Corp. Interesting. This has got to be a SPAC. And a SPAC maybe with a pending, maybe not a pending merger, maybe a pending merger between now and July 16th. And let me tell you how I make that guess, right? I guess on that because, we look and see that it's closed at 10:09 on Friday, right? And, that's decently close to 10. So you'd expect to see maybe some premium in the 10-strike puts. However, you see nothing. There's zero premium. And what that indicates to me is that the market views there's no risk of this thing going back down below 10 by next Friday. However, when you look out to July, you see 60 to 70 cents of premium, meaning that there's a decent risk that this thing goes down below 10 between now and July. So that's potentially when there would be a merger on this. Let's see what it is, when the merger's coming up. They are in negotiations. FREYR, Alusa Energy Corp, reports business combo with Freyr, an $850 million deal. This came out on March 26th. March 26th is right around here. What happened back in February right here? Let's see. Oh, it looks like that's maybe when the rumors began, which is when it ran from 10 up to 15. But, long story short, this is a SPAC. I don't know when the actual deal is going to go through. Let's take a look at Take a look at the news real quick, see what we can see. Looks like on February 15th, they approved the business combination. I don't know when the business combination is actually going to occur. And I don't really want to read this entire wall of text live in front of you guys. So, but long story short, it's a SPAC at net asset value. What that means is that the way a SPAC is structured, it can't really go below the net asset value. And the net asset value is right around here, just below $10 a share. Reason being is because as of right now, the corporate structure of ALUS is it's just a company full of cash. And on a short term, week to week, month to month basis, the value of cash doesn't change. So the value of cash in this holding company is about $10 a share. So now that we see it's $10 a share, the cash isn't going to lose its value like that. So what we know is as long as there's no merger, it's not really going to drop below 10. So that is one way that you could use that knowledge of net asset value in the context of a SPAC to help you out there. Now, question 2 is what's going to happen post-merger? Now, here's some good charts I like to bring up. Here's Hyliion. This was when their merger was. I think it went from 50 down to, back down below 10. And as you can see, that concept of net asset value, even on a stock as crazy as Hyliion, when it dipped below the net asset value, it came right back up. CLOV is another example of a SPAC. Had that net asset value around 10. Every time it dipped below, it came back up. And CLOV might not be the greatest example because it came way back up. Fisker FSR, another SPAC, ran up, down, and back up. I think RMO was also a SPAC. Yep, ran way below, but as you can see, it's rebounded back up. So while post-merger, there may be some risk that it does drop below 10. I think with these charts that we've looked at and the SPACs that I can name off the top of my head, you can at least rest assured a little bit that it'll pop back above 10. Here's another great chart. UWMC was trading right around that $10 level, came way down, but eventually made it all the way back up to 10, where it's currently sitting on Friday. So ALUS, maybe not the worst idea in the world. The only question I would have, is about how to play it. Do you sell the 10 strike put a month away, where you're getting a 7% ROR, that's good for 1 month of returns. It doesn't look like you get the greatest margin buying privileges on that one. So as far as what I'm looking at, that might not be the best for what I seek, but premium looks kind of dead across the board. So as far as in the context of our strategy, I think this might be one to stay away from until they have that merger. Maybe keep an eye on it. If it does drop down to the $9, $8, $7 level, that's when we could pounce on it, knowing what we know from all the SPAC charts that we've taken a look at, where, hey, while in the short term it might have dropped down to 9, 8, or 7, we can reasonably count on it to come back up. So I guess conclusion on that one, keep an eye on it, see if it comes back. But right now, a little bit risky for me, especially when you take into account the lack of premium on the options. But hey, if you're an option buyer, lack of premium, hey, that's a great thing. If you think it's going to shoot up, you could buy a 10 strike. Well, you could buy a 10 strike call, but your break even is now 8% above where the stock is. And, maybe not the greatest value proposition there. And that's why we personally are not option buyers. But we'll keep moving down the list of what got thrown in the chat. Let's see. We got ALUS, JWP, looking at Tesla, Square, etc. Dashio wanted to look at AREC. All right, we're going to take a look at Tesla. We're going to take a look at AREC. And we're going to take a look at Square. And then that should get us down near the end of our stream, because we're a little bit over, I think we're a little bit over an hour right now. In my room, I feel like it's getting hotter by the minute in here. So let's take a look at Tesla. This is an interesting one to look at. I am a pretty big Tesla bear, admittedly. And, just looking at this chart setup and what those of you who are following me have heard me say about similar chart setups is that, typically when you see something like this, the pullback from 900 to 600 usually isn't the end of that pullback. We could pull up another chart where it looks like that for a while. I keep going back to Hyliion. Maybe not apples to apples right there, fair enough. But, this elevated valuation, I feel like at the end of the day, valuation trumps everything, the numbers are going to win out eventually. And while in the short term from, last March to where it peaked in February, that's a 1 year run that is absolutely insane to think about for a company of its size. And especially the fact that they had this 5-to-1 stock split and then further ran almost because of that. It just does not make sense to me. We got Jules in the YouTube chat saying she loves Tesla. Jules, I would never get in the way of any stock that you claim to love. However, this is one personally I stay away from. But, if this is the stock for you, we could take a look at the option chain to see what that premium is looking like and what you can expect going forward from here. So, from an ROR perspective, Tesla offers some really attractive returns. And the reason for that is because I think the perceived immediate downside risk in the future here. I personally would not want to get into Tesla until it gets down into this low 400 range. I think that's a better area to start playing it in. But if you are convinced that the 600 is a good spot to jump in, more power to you. Let's take a look at how you would want to jump in on this. You could get 600 strike puts for $10 a premium, and we know that 600 strike minus the 10 premium puts your break-even price at 590. Maybe the 3-year chart's a little misleading for what we're looking at here, but you'd have a 590 break-even. And as you can see, for the range that it's traded in over the past month, that's not the greatest value because there's a range of way it bottomed out at 545, peaked at 635. And the fact that on a week-to-week basis, you could get a 1.69% ROR. And, we've seen risky stocks. We've seen what RORs can get up to. They can get up to the 3, 4, 5 range for some of those riskier stocks. Do you really like the value that a 1.69% ROR gives you for only a $20 cushion, which looks like this on the chart? When looking in the context of the entire trading month, the price has been all over the place like this. To me, that's not something that is incredibly attractive. I mean, we can go back to the 5-day chart, and even then, in the last 5 days, we could see that that it's traded below where your break-even price would be. So for me, that's not something that I think is the best idea for a potential trade or investment. The other decent thing, 50% margin privileges, so still not great leverage that they offer on that one because it is definitely a little bit riskier stock, especially at this level. But yeah, just the way it sets up for what we're trying to accomplish, the premium we're trying to collect, the break-even price it gives you when viewed in conjunction with areas of support and recent trading ranges really just does not look incredible for me. So that's why, for me, I'm staying away. If it gets back here, we'll talk. But, another point to make about this one is while we've seen these big swings that were last Monday and Tuesday, Wednesday, Thursday, Friday, it traded, relatively flat. So, obviously a great time to jump in on cash secured puts is when there's some serious volatility in the stock. So I think Tuesday morning, like when you saw the drop from 623 down to 595, that would have been a hell of a time to sell some puts because that premium would have been inflated. And even though, it dropped down to 596 and was about at that price Wednesday afternoon after the Tuesday morning drop, if you sold near the bottom on Tuesday morning, you probably would have seen almost 50% of your max possible return come Wednesday afternoon. So that's why we try to sit on our hands a little bit. Don't get too married to a trade that we look at Sunday night because Monday morning things might look entirely different. And so many times during the week, you see situations like this where something sets itself up during the trading week that gives you a much better entry. I'm getting booed in the YouTube chat by Jules. That's okay, Jules. We're going to have to agree to disagree on this one. So I apologize to you specifically for that analysis. But yeah, like Dashio mentioned, Dashio doesn't like the chart. And Dashio, I got to give him credit. He said when RH broke through 680, he said he thought it was going to go to 700. And lo and behold, it went to 700. So we may have a personal chart wizard in our Twitch chat. So shout out to Dashio for that one. But, going forward with the other stock that we were going to take a look at, Tesla and Square SQ, your favorite payment processing company. 3-year chart, it's really, really similar. All these tech companies and, I guess EV in the case of Tesla have these crazy, crazy run-ups when you look at them in the context of the past 1, 2, or 3 years, which scare me a little bit because, not often you're going to see some sort of leveling off at these levels. Something's got to give. Although I will say, when we look at the 3-year, it has fallen back to being at a level of neither overbought nor oversold. So, maybe indicators above all else right here. I think RSI is giving you the green light to maybe start playing it, but let's take a look at the 180-day, look at some more recent trends, where it's definitely leveled off a little bit, and this chart looks like there's some pretty clean support right at the 200 level, right? We see a bounce. It went just below it, but bounced quickly back up in January. Same deal with March, same deal with the end of March, and then a little bit at mid to late May. But 200 is a decent spot that I'd be comfortable getting in at. But right now, I don't think there's anything stopping this from bouncing off what could be resistance at 225 and shooting back down to 200. And the amount of premium you're seeing on a week-to-week basis with this one really just doesn't reflect the risk that I feel that chart carries. And again, I'm not some huge TA wizard or anything, and I definitely don't claim to be some magical chart reader, but that's just my 2 cents when I take a look at that. I'll always tell people who are listening along and following along that we can agree. I'm happy to disagree with you on what a stock is going to do. I just think the only important thing that we agree on is how to play it, and that how to play it is selling options. So, I mean, you could go down to, 210 or something like that where, the ROR isn't going to be great. Let's see if you get a little bit of leverage here. Yeah, a decent bit of leverage where you, instead of pulling 144 off of 20K, you could pull 144 off of $3,400. Calculator is back. 144 divided by 34.51. 4.1% ROC, not bad at 210. Break even price 208 on the week, but what scares me about something like that is a 3% move in the context of the market, and especially the context of the sector SQ is in, is not that big of a move. If SQ drops 3%, it's already down at 212 and knocking on the door of that 210 strike put. So, one decently red day on it this week, and it has flown down through your lower support that you're looking for. I mean, we could zoom in a little bit more to the 20-day, which is the last trading month going back to May 14th. Your break even would be right here. Even the biggest red days that we've seen in the past month have been from 208 down to, 199, so a $10 drop. The 210s aren't horrible. They're not the worst thing in the world. So if you were to sell like maybe 3 of these, tie up about 10 grand to pull $432, not the worst thing in the world. Handpay Harry checking into the YouTube chat. How's it going, man? Last week, I think it was last week, it might have been 2 weeks ago, but I finally told the Hyliion story from beginning to end. You'd been requesting for those in the YouTube comments, and I felt bad when I had forgotten about those. So hopefully, if you were able to watch either last week's episode or the week before it, you were able to see that Hyliion story that I think you'd been requesting. And if you hadn't seen it yet and want to skip around to the video, it's at the end of one of them. So hopefully that got you what you were looking for there. But appreciate you following, commenting on the videos, and checking into the chat tonight. So one more stock that we had listed in there. Let's see, it was from Dashio, I think, and it was an oil and gas company that I cannot remember the name. AREC is what it was. All right. Oh, Joe, what's going on, Joe? Good deal. Appreciate you checking in, Joe. All right, we're looking at AREC now, 285. It's leveled out here. Really good entry point when we're looking at something like this, because as you can see, we've talked about this so much where it runs from 280 up to 460, and everyone wants to get into this stock at 350 or 450. What we try to preach is, when you cut it off here, you have a chart that looks like this. People say, oh, I want to get in. Normally what happens is we zoom back out, and it's going to fall back down. This happens so often, so often, is why we want to exercise patience when we see a stock run up like this, because just as quickly it could fall back down. But to the point of the strategy we're running, the conversation we're having tonight, when it falls back down like this, we're going to see some serious IV in the options that we could sell. And honestly, nothing too crazy on a week-to-week basis here. Normally, this is monthly option expiry week. Some stocks only have options that expire every single month as opposed to weekly. So, coming up on monthly option expiry week means you could open a 1 week trade on a stock where typically these options would be, you'd have to wait a month at a time. So typically a good opportunity with something like this, but we just don't see a ton of, neither a ton of premium nor a ton of volume on these. If you wanted to go a month out to July, that gets you, 30 cents a premium on a 2.5 to give you a 220 break even. That doesn't look like the worst thing in the world. Let's back it up a year. It looks like your maybe more immediate downside back in January was trading at 230. But, I think you'd see some support around that 230 range. So if you wanted to jump in July, get 30 cents a premium on something like that, not the worst thing in the world. There's not a great leverage opportunity here. Normally your max loss would be $2,200 and the buying power effect is $1,600. So TD is not giving you a ton of help on that side of things. So it would be a true, 13.64% return if that's something you tried to pursue. But, not enough for me to get in on something this risky, potentially down to $1. So that's one I would stay away from. But if you're looking for a low entry trade, we did look at IVR. That was a low entry trade. AHT, we were looking at ATOS, I think is the name of the other stock that we got on. ATOS, that's the one where in the short term we sold a 4-strike put that expires in a week. I mean, that one's a little bit riskier, but the premium on it looks pretty nice. So we were happy to jump in on that one, at least for the short term. But if you're looking for something like that, this is definitely a trade in reference to AREC that we were just looking at. Where'd it go? I think it was called AREC. Yes. So if you wanted to go out to July, maybe cut your risk down a little bit, that wouldn't be the worst thing in the world right there. But we're personally going to stay away from that one. That is our analysis on that stock, and I think that pretty much closed. We could look at one more for Prinsmeister in the Twitch chat. Another potentially low entry stock here. It's going to be GNUS, and I will say we have played this one before. I don't know what the price is, but it was around, I think, $1.90 when we jumped into it. Look at that, still around $1.90. I don't remember when exactly we played it, but I think it was right around here with these big candles because we love the volatility that those offered. But right around $2 a share. It's got weekly options, so that's really nice, and there's some really, really attractive 6.1% ROR. Let's see what kind of ROC we're getting. We're getting no ROC right there because it requires more money actually than our max loss. So no leverage help from our broker on that one. On a week-to-week basis, looks like you'd be able to jump in with about a $1.90 basis. And if we look at the last 5 days, I mean, this thing on Monday was down to 176. We look at the last month of trading, it was down to 132. Yeah, a week-to-week 190 basis is a little bit scary, knowing if it decides to drop back down to 170 or 160, you're looking at a 10 to 20% loss off the bat. So that one's a little bit riskier for me. I personally would wait. If you look at the movement in this chart, it's pretty steady. Obviously, it's an upwards grind because it makes from $1.32 up to $2. It's pretty steady, but normally the premium that we like to sell and that implied volatility is derived from when we see a sharp drop, something like this, from 220 down to 194, and that drop from 220 down to 194 should also do a pretty good job of giving you an idea of how quickly a stock like this can turn around. So Prinsmeister did mention you can go a week or two out. Not a terrible idea. You'd be able to get yourself in with a 188 basis compared to a 183, which might not be the I think you've got a lot. I guess I should say there seems to be a lot more value in selling short term as opposed to going 2 weeks out here, because if you are a sign on the stairs, right, you could just continue along with the HT wheel strategy we run and can sell those covered calls and continue to knock that basis down week after week. Holmes HC, shout out to Holmes HC checking in the Twitch chat saying a friend told him if he wanted to lose all of his money fast to trade options, so he's here to learn. And I've got some news for you, Holmes HC. We do not lose around here. At least, I try not to lose around here. We could take a look at our year-to-date summary, but we've made money every single month. Our account balance chart is moving up and to the right, and our performance versus the S&P 500 is also moving up and up and to the right. So I will say if someone wanted to lose their money fast, they could buy options. But as we say so often on here, we sell options and take money from those who are buying them. So if you were completely new to options, and this is a good little spiel for, I guess, maybe anyone on here who's checking in randomly, watching the stream on Twitch or YouTube, but if you're brand new to options and don't understand what exactly we're doing here in the context of selling options, for starters, that is 100% okay, because no one was born with financial knowledge. Even the best traders on planet Earth had zero idea how options or trading or anything worked when they came out of the womb. So we all started from the same spot. I mean, a few years ago, I didn't know too much about selling options either. You know, Holmes in the Twitch chat saying he only has long positions on equities so far. And that's great because, you know, I feel like a lot of traders, you know, will make this transition through different types of trading. I mean, I started off just buying stock. I got bored by that. I started trading penny stocks, and I lost a lot of money doing that, which, you know, also hammers home the point that there are really no shortcuts in the market. So I tried penny stocks. That didn't go very well. And then I switched into options, buying options, that is, and that didn't go well either. I lost a very good amount of money in a pretty short amount of time. And at the end of the day, I finally took a step back and said, you know, I'm buying all these options. I'm losing all this money. Who is making all of this money that I'm losing? And the answer is the person that was selling it to me. So, you know, I took a little bit of time to learn about how option selling works, how all this comes together, you know, what premiums are, what you should look for in a stock, how selling cash secured puts, how selling covered calls works, you know, and I was able to put those plays into action, and I've seen some really, really nice returns. You know, last year might be a little bit of an outlier because premium was so high due to the COVID drop, but we pulled about 160% last year. And even a lot of people said heading into 2021, you know, it quote unquote, you know, it wouldn't be that easy. We're up at 63% this year, and we are just before the halfway point of the year. So I'm hoping we can get it up to 100 by year end. So that's something that's been really nice for us, but also goes to illustrate how consistent and how profitable a good option selling strategy can be. And I say good option selling strategy, that includes a lot of the principles that we teach in our HT wheel strategy, which if you're brand new, I think maybe that video or video series that we have on our YouTube channel would be a really good place to start. Because, you know, if someone, when I first started trading options, came up to me and just hit me in the side of the head and taught me about option selling, I would be so much better off than I am right now, because I think back to those years wasted, you know, trying out different trading strategies where I would inevitably lose money and move on to the next one, and until I finally found the strategy that works. And this isn't a strategy that works because we got super, super lucky and, you know, we're just on a heater or something like that. This is a strategy that works because if you look at things we're selling, for example, we're selling a Zillow 100 strike put, you know, our max profit is if this comes out of the money or finishes out of the money. We're setting up a play where, you know, the 100 strike put that I sold has a 91.73% chance. Excuse me, I don't know why I said that number weirdly. But, you know, we're setting up plays where the 100 strike put that we sell has a 91.7% chance of winning. So we have a 91.7% chance of hitting max profit on this. And if we keep setting up these high percentage trades week after week after week, you know, our account balance is going to be looking like this, a general trend up and to the right. And I tell so many people, you can get so suckered into these option buying strategies because it's so easy to see someone who took a $2,000 trade and turned it into 10 grand and think, oh, wow, that's awesome. That's going to be me. But to that, I say, you know, you could see someone turn $1 into thousands of dollars playing the lottery, but that doesn't mean the lottery is a good idea. Every now and then someone goes to Vegas and is going to win some money, but, you know, the house always wins in the end. And by putting ourselves in positions with high probabilities of profit, we effectively turn ourselves into the house, and in the end we are going to see this trend in our account over and over and over, provided we stick to our strategy, make educated plays, and follow our principles, and, you know, remember that there are no shortcuts in the market, and don't get ourselves caught chasing the carrot. So that is my little spiel about our strategy for any of you who are, you know, new to following, new to watching, and I guess new to maybe some of the psychology or strategy behind what we're doing. So that was hopefully a little bit of a helpful spiel at the end of our stream here. But with that said, you know, we've yeah, there we go. I'm talking your language when I talk high probability. I love to hear it. And while it may not make sense to you right now when I say this, what we're doing right now, they're glorified long positions in stock. So it's not going to be too far removed from, the level of risk that you're already taking on by having your portfolio long in stock on the market. So that's something that that's something that I think a lot of people get scared when they hear about selling options, because a lot of people don't really know the right way to go about it and can make it pretty risky on themselves. But as we've proven, as we teach in what we're doing right here, we hopefully can help you avoid that and have avoided that and put ourselves in positions with defined gains, defined losses, and chase these 1, 2, 3, 4% returns a week, which compound to really nice numbers and really nice results, over the course of a week, a month, and a year. So that is what we stick to on this channel. That is what we're going to do going forward. And that is going to be how we wrap up our stream. We've got 3, decent stocks, decent trade ideas that we're looking at. But again, as so many of you who follow us know, during the week, so much happens during the market, and so many different setups and opportunities present themselves during the trading days, Monday, Tuesday, Wednesday, you name it, as opposed to Sunday night when there's only so much research we could do. So that's why we've got our Discord server. If you guys aren't in that, feel free to join. I think you could find the link both on our Twitch, YouTube, on our Twitter. We've got a link to join our Discord server. Again, all of this is totally free, but feel free to join. And during the week, we post all of our trades there. So if any of those setups that I did allude to present themselves during the week, obviously, if I'm busy with work or something, I've found it super helpful because someone else will be calling it out. And if someone else is busy, I'm calling out my trades in one of my dedicated trade channels that you guys can see and get notifications on. So, we're all kind of helping each other out. And hopefully the idea is we're winning together, because it, doesn't cost me a single dollar to help you guys make a dollar, and vice versa. We're not these huge multi-million dollar accounts trying to move hundreds of millions of dollars through the system. So, it's pretty easy for us all to win together, and that's what we're going to be sticking to heading forward. But with that said, I am finally going to put an end to the stream tonight. Appreciate all of you who tuned in, and I hope to see you again next week. We do this every single night, Sunday around 9 or 10 Eastern, and that also, whether it's 9 or 10 Eastern, gets announced in our Discord server. But appreciate you guys tuning in. We're going to sign off the way that we sign off in all of our videos, saying, thanks for watching. This has been the Hourglass Trader, where as time passes, we make money. Thank you for watching. And again, hopefully we will see you next Sunday and, this week in the Discord server.